Your CPA is going to tell you the tax implications and like the rules on the taxes, and your syndication attorney is going to give you like, oh, here's legally how you need to set it up. But there's no one that is telling you how those things are coming together,
Mm.
and you really just have to figure it out.
Right. Everyone, welcome back again to another episode of Action Takers Unscripted. I am your host, Arsenio Hart, and today I have Chris from EM Capital here to share his thoughts, share his journey, and share some actionable steps that you can take in order to be an investor or just to get started in the real estate environment. And Chris, welcome to the show, man. Thank you for coming on today, and I'm excited to have you on.
Yeah, thanks for having me, Arsenio. I'm looking forward to it.
Awesome, awesome. So Chris, if you don't mind, just give a little introduction about who you are and what EM Capital brings to the table and what you guys do in the real estate environment.
Yeah, so EM Capital is a multifamily real estate investing company. We're located in Boston, Mass. We started off buying apartments here in the Boston area, but now we focus exclusively on the Southeast. So North Carolina down to Northern Florida. We look for multifamily assets, Class A and B, in between 10 and $50 million acquisition price. And we look for a value add component. So we want to be able to, add revenue sources, do renovations, do deferred maintenance, management terms, something that adds value beyond just appreciation.
So, you said you typically focus on the multifamily projects in pretty much the eastern side of the U.S.
Yeah, the Southeast.
Okay, so that's your primary focus. Do you have any specific like you said class A type properties?
We typically focus on Class Bs or
Okay,
Cs that we can
class
get
B
to
and C.
Class
Okay.
Bs.
Yep.
And then we have a couple, call them like A minus properties or like affordable value, kind of
Yes.
like below that top tier,
Mm.
but certainly above a B, kind of like an A minus
And that's
property.
typically where you have the value add because typically those class A's, those are pretty much appreciation, not really value add type deals. Those
Right.
are
I mean, they're brand new.
yeah, they're
What are you
brand
going to do?
new. So it's
Yeah.
really not really value add there. Those are just like high end market type deals. So the value adds is where the B and C classes are come into good play. Um, let's see, where do you think is some I want to get into when you look into these criteria because we looking for when you're looking for the team or how is your team structured in regards to looking for these deals?
So we have, we have an acquisitions lead. And then, what he basically does is develop broker relationships in these target markets that we're looking at. So we're subscribed to all the different broker lists, right? So we get all the emails that come in. And in addition, we try to touch all the brokers on a regular basis so that when they have deals that maybe are like limited distribution or kind of pocket deals, that we're on that list, the people that get those, or ideally top of the list, but they're always going to send those to a group of people.
Hmm.
So the goal is to get on that sort of short list. Um, and then we, every deal that comes in, we put it into our kind of deal flow tracker, and it goes through. Does it meet our high level criteria? Not, it gets sort of tossed. Then we send the brokers an email that says, thanks, but this is why we're not interested. Next step, kind of dig deeper, location criteria, specifics on the deal. Same thing. There's just like a tighter net on that. And then if it doesn't pass that, similar process. And then if it gets through those two screens, we go to a first pass underwriting or acquisitions lead. Goes through like a quick, maybe half an hour underwrite just to make sure things look close,
Hmm.
like it might work. And then we get on the call with the broker, hash out some of the details, get more specifics. What's the whisper price? What do you think they'll take, to not fully go to market, to get it done early? What, just kind of like all the details about it. And if things still looking good, we go into a full underwriting where, we'd spend a lot of time on it, figuring out what all the comps really are, not looking at the broker pro forma, but coming up with all our own assumptions to make sure that we think that it meets our criteria. And then if it passes all that, we go to like an investment committee. We sort of like poke at the deal. But usually on these bigger deals, we bring in some partners. So we kind of pitch it to them, and then um, tell us if they like it, and they ask us questions. And if it holds up through that, we'll go through, put in an offer, and trying to move forward on it.
So we know when it comes to multifamily, we talk about its syndications. Can you kind of briefly explain um, what a syndication does as far as the context of the multifamily investing?
Sure. I mean, a syndication, can be done for any investment. So it's effectively just raising capital from a number of different people and having them participate in the purchase of really anything, but in my case, a multifamily investment property as a partial owner. So typically, the way that works is we'll work with um, an attorney to put together a private placement memorandum and an operating agreement that defines the terms. So we typically own between 20 and 40% of the asset as a sponsor slash manager. The equity partners typically own as a group, 60 to 80% of that entity, and then that limited partner entity or investors. We offer this as an investment to either kind of friends and family, or to a larger group of accredited investors, which allows us to advertise. And then they evaluate the deal. They're interested. They submit. They sign a private placement memorandum. They sign a subscription agreement. They wire their funds in, and then they get a portion of the equity in the property when we close. So we get compensated for finding the deal, financing the deal, managing it, raising all the capital, and then we typically hold it for 5 years. 3 to 7 is sort of the range, market dependent, depending on what's going on with interest rates. So then the investors get their percentage of the cash flow along the way, and then at sale, we usually have a preferred return. So they'll get either their preferred return along the hold period, or they'll get caught up on their preferred return if we didn't hit the full projections. And then after that catch up, they'll get their percentage of the profit at sale. So it's really a way for someone to participate in a multifamily investment, or any investment really, with limited liability. You're not liable for anything that happens in the property. You can't be sued can't really lose any more than you put in, and the likelihood of that is pretty low. And then you have no real operating responsibilities for the property. So your job as a limited partner is really just make the investment, read the emails, ask questions, as you see fit, and then cash your checks. We provide our limited partners with as much information as they want, just because a lot of times we find that they're interested in real estate, they just don't have the time. So like the more the better. But really, there's no responsibility day to day for them.
I do enjoy having the conversations with my investors, especially when they have some really deep questions or have questions, and because they're lending their money to you as a capital raiser, and they're trusting in you, not just the deal, but they're trusting in you to make sure that
Right.
they're receiving a good investment, or a good return on their investment. So building that trust, and answering their questions, being open, being honest with them, even when something's not going right, it goes a long way. So integrity is one of those key things that I have when I'm talking to my investors, and sharing the details that it all entails with it. I want to show not just the good side, but the risk that's involved with investing in a syndication. So anything could happen,
Right.
so you want to make sure that you have that trust, you have that integrity built into the system. So yeah, thank you for answering that. So another thing I wanted to bring up, because you talked about um, some unique advantages. But I would like to dive a little bit deeper as far as um, what uh, what type of unique advantages does a syndication bring to an investment, and then as far as when investors maybe you know might not be able to achieve their own might not be able to achieve on their own, but as far as like when it comes to a syndication, what do you think is some unique advantages of that?
Well, so I mean, I think when I first started, we have a lot of like these three families in Boston, three deckers. They're like three apartments stacked on top of each other. If you ever seen any of the Boston, gangster movies? They're all over.
I got you.
Um, so I started buying those kind of in my mid 20s, and I saved up and I bought one, and it was cash flowing okay,
Mm.
but it took like 3 years and some funds from my W-2 job to save up enough to buy the next one. So it didn't, although I liked it, and in the end it really worked out well. It was hard to see a path for real growth with that model
Mm.
because it was like save, buy the next one, save, buy the next one, and it just would take forever, right?
Mm.
And what syndication or just really equity partnerships get you is the ability to scale faster, right? So, in that same scenario, you just find someone who's interested in real estate that's very busy but has a lot of cash to put to work.
Mm.
You do a joint venture. Now you can grow that much faster. You take their funds, you split it, however you want to do it. Now you can acquire maybe one a year if you get a new partner a year. So, and then what syndication does is it basically just multiplies that. So you have a pool of investors. You're constantly looking for good deals. You're constantly trying to grow that pool of investors and keep them educated and let them know what you're up to, so that when you find a good deal, you're not worried about your capital. You can grow as a business. They can get quality returns, and you can just scale a lot faster.
Yeah.
And for me, it wasn't really until I figured out that model that I was comfortable leaving my W-2 job and seeing this as a business and not just a side thing that would be great at retirement when I
Mm.
finally sold all these things or had no debt on them. So it kind of opened my eyes to a business model that I didn't understand before.
Nice. You talked about your W-2, and you ended up leaving it because of the joint ventures that you had, and real estate was that foundation to get you going. And I'm assuming making you create EM Capital and move on from there and go to Raise Masters and be a Raise Masters and everything. We'll get into that. But what was your W-2, and what was it that you know um, we know real estate was a factor that made you change. But what was it that you saw on the W-2 side that you translated over to real estate, or that just made you like, real estate is it? Okay, I've hit this number or I hit this target. I can let go of this W-2 and move forward and go full force, full sprint into real estate.
Yeah. So for after college, started working in effectively an aerospace company
Okay.
that worked for a defense contractor here in Boston. And we did primarily contracts for the Navy. So I was a mechanical engineer, got a master's, enjoyed the job, kind of went up the corporate ladder, and I was there for 17 years. Um, in parallel, almost right away, I got an apartment with some friends. I was like, geez, we're paying a lot of rent. Who owns this place? How does this work? And
Mhm.
just started, reading books and talking to people and just learning about, real estate. Just I knew very little about real estate, no more than anyone else did. And I was really curious, and there was no, podcasts back then. And there was a handful of books that were decent. So I bought my first four family when I was 24, and I just really liked it. I liked that it was hands-on. I liked that I could make these big decisions, and it was exciting, and I had a lot of self-direction. And then on the job side, I enjoyed the work, but very little autonomy. Well, not necessarily autonomy, but like control authority, right? Like I wasn't directing where where the Department of Defense was putting its budget for the
Mm.
projects that were happening. I was a piece, a relatively small piece of a much bigger program that was slow and kind of inefficient and somewhat frustrating at times. So as I grew my real estate portfolio on the side, I was growing in my career, and I'm more and more like I really like the real estate stuff. And it wasn't until I came up with two kind of concepts that gave me the confidence to move forward. One was, like I said, effectively raising capital, because that gave me an avenue of, could this be scaled? And that was how you could scale it. Before that, I didn't, like I said, I didn't see it as a business. I saw it as like a good thing to do on the side for, retirement or, extra income.
Right.
And then the second thing was location. So the tough part about Boston is it's expensive. The rents are high, but the prices are very high, and it's kind of a real estate savvy market. Like everyone's sort of looking at real estate all the time. It's kind of always been like that. And I just came across the concept that there's different markets out there, and different markets have different characteristics. So some are appreciation markets, some are cash flow markets, and then there's like the holy grail, which is a cash flow market that's transitioning to an appreciation market.
Mm.
So kind of grabbed that concept, started thinking about it more, and found some areas around Boston, like within about an hour and a half, that I felt I knew had better, at a gross level rent to price ratio.
Mm.
So I could, get $1,000 in rent for a property that was only, say, $200,000 a unit in this market, where in Boston, that same ratio was worse. So bought a 5-family in one of those markets about an hour away, and decided that I was going to have that fully property managed. So, hired a property manager, and my thought process there was, I'm going to treat this like it's in Florida. Like I'm going to go there every quarter. I'm not running up there when there's a problem. Relying on the property manager to handle it. And I wanted to see if I could do it, right? Because I'd been so hands-on that I was wondering, like, is that going to drive me crazy?
Mm.
And it was great. I mean, I learned a lot. I certainly have some good stories about it. There was a fire, there was a lot of things, but I learned a lot,
Mm.
and it worked out. So those two things really, like, focusing on, you don't have to invest in your own backyard. And that's kind of, a lot of people say that's the first rule of real estate, right? Like invest in your own backyard. But well, yeah, great if your own backyard is like Dallas 10 years ago. But if it's not, you don't have to do
Right.
that. So for that and capital raising, I think were kind of the big things that enabled me to get the confidence. And then I think just learning more about what I wanted out of my career. We had a good kind of leadership / emotional intelligence consultant that did the year-long program at my company. And as we're going through this process, I was like, oh, I just really don't like this job. Like, I don't like where this is going. It was like my favorite part of work for like a year, was having these sessions and talking about, like, what makes you feel accomplishment. And I just realized that at work, I just kept feeling like I was hitting a wall. Whereas on the real estate side, I could make decisions, do research, and then say, all right, this is what's happening. And it would happen.
Yeah.
Or not, but I learned from it, and it was on me.
Definitely
So that
lessons
was
learned.
kind of made it happen.
Yeah. You share a great point there. And again, I say again, but I just want to iterate something here as far as, having a W-2. It's nothing wrong with having a W-2. And that's not where we're trying to knock any W-2s or anyone that's in a working environment. We understand you have to make ends meet, you got to pay your bills. You got to do that. What we're trying to share here is real estate is a vehicle to get you out of that W-2. If you enjoy your job, you don't have to quit it. You can still enjoy your job and still be an investor and still do things in the real estate sector. Because I'm doing it now. So I'm still in the military. I'm still
Yep.
doing taking care of family, but I'm still doing real estate on the side. It's just where does your goals align? Are you wanting to be passive? Are you wanting to be active? or you want to be a limited partner in a deal joint venture? Do you want to be hands-on? Do you want to be laid back? It just depends on each and everyone's goals and what you want to do. And Chris
And
found
it
a
depends on your
way.
situation, right?
Oh
Like how
yeah, oh
much
yeah,
time do you
absolutely.
have? What are your commitments?
Mm,
What's your interests? Like
mm.
what do you enjoy? Yeah.
Yeah, yeah. So you found a way to, like, you enjoyed real estate even from a young age, and now you're at the point where you have your own company. You know what it looks and you know what it takes uh, to be where you are now. So um, uh, let's go back a little bit. Our transition to now. How did you find EM Capital? What was it that made you create this company? And I guess, what do you see in the future for EM Capital, and what are your goals, and what are you guys looking for?
Yeah. So when I first, sort of left my company and went on my own, I wasn't really thinking about, I mean, obviously I had to start an LLC, right? But I
Mm,
wasn't thinking about I wanted a company.
right.
I was just thinking I was going to be, spend my days managing my properties, managing my managers, my property managers, looking for deals, raising capital, sort of
Mm,
just doing it all, right? And partnered with a few people, got some traction, got a few properties, and quickly realized that it's a lot of work, right? There's to do those three things, and I always think those are like the three fundamental pillars. There's of of multifamily, at least syndication, like operations, running your deals, acquisitions,
mm,
constantly underwriting, looking for new deals, and then raising capital and keeping that, you know, keeping your company top of mind so that when you have to raise capital, it's not like you're cold calling people.
mhm.
And those are three different skill sets, and they're all time consuming. So, after not that long, I was like, oh, I need to figure out how to bring people on, whether it's partnerships, whether it's hiring people. Um, so it's happened organically. I sort of, as I realized where my skills don't lie, I partnered with someone to help augment that. Hired some people to help me out. Um, and then, yeah, so that's sort of where I came today. Just grew organically. And then moving forward, we'd like to do 100 million in acquisitions this year, and we're about halfway there. We can get this deal closed that we're working on, and I want to keep expanding in the multifamily area.
Mm,
And then also I want to expand into industrial and retail, kind of on the smaller end, kind of $5 to $15 million
okay.
properties, and have like a diverse offering for my
Mm,
investors. Um, so that's sort of just getting started, uh, you know, as far as our new offerings go. But just because I find that interesting, I think it offers a diverse portfolio for investors. And also, multifamily has been kind of dry for the last year and a half, starting to pick up. So I feel like having those different asset classes helps kind of smooth things out.
and diversify it too, so you
Yeah,
kind of
exactly.
not just don't have all your eggs in one basket. You're out there and diversifying yourself. So that's good. I I want to go back to, we talked about um having trust in our investors and everything. So can you talk about the building on the trust with your investors and the building of trust within your team, how important that is, or why it's important to do so?
Sure. Yeah. I mean, I think it's critical, right?
Mhm,
The one thing about syndications that's probably different than equity is there's usually minimums,
mhm,
and they're usually pretty high, right?
mhm,
If we're raising 22 million for our current deal. So our minimums is $50,000. And that's a lot of investors if everyone invests the minimum. So imagine if you had like a 10K minimum,
yeah,
right? You'd be dealing with thousands of investors. So the minimums are relatively high, like 50K, 100K. Um, and the transparency may not be there that well, right? Like these are not Fortune 500 companies you're investing in. They're not being audited by a big four accounting firm. So there's a lot of trust there.
mm,
And you have to kind of know that this person knows what they're doing, that they're not hiding something from you, and that they're going to be open with you. So, trust is required everywhere in all businesses, but people are putting a good amount of their hard-earned money with you. and they're relying on you to do what you say you're going to do to get their returns and to get their
Right.
money back and to get their returns. So yeah, it's critical. I think transparency is the big thing for trust. Kind of being very open with what the risks are, with what your concerns are, what you're doing to mitigate them, of course. But it's especially if you're excited about a deal, it's kind of a balance because you don't want to be too enthusiastic about it because you have to make sure that you're highlighting like, hey, here's all the potential downsides. I mean, this is not all guaranteed upside by any means. Um, so I just think being transparent and honest, is the best way to go.
I, I can tell you right now, there have been times where I've been so excited about a deal, and I think I was too excited, where investors was like, yeah, I'm not gonna invest in this deal. I just like it's good to be excited. It's good to be excited about a deal and be energetic, but you want to actually, ensure that you know those red flags too. Like you gotta ensure that you're not just, you know, it's not just all emotion, but you gotta be considerate of those red flags. Do you have any like common red flags that you see in a deal that you're like, okay, if I see this certain criteria or I see this is a red flag, I'm just not gonna invest in this deal
Yeah,
at all.
definitely. So we don't go anywhere near flood zones,
Mm.
um, especially like coastal flood zones.
Oh
Like,
yeah.
I think insurance is a huge risk out there right now, and it's already been realized in a lot of cases. But it's an uncontrollable cost that could go up dramatically. So try to mitigate that as much as we can. So if something's in a flood zone, like even a flood zone adjacent, just not interested. Could be a great deal. Maybe we'll miss out on it, but
Mm.
we're not going to lose big on it. That's for sure. Um, Try to avoid any neighborhoods that are um, like very low income. So we use justice maps a lot, and it gives like a heat map of like household income,
Okay.
and try to stay in the either on the edge of the higher end or in the higher end income areas. I mean, I'm not saying like the top end, but there's certain areas that maybe they'll be great in 10 years, but I don't want to bet on. I want to see demonstrated improvement in the
Mm.
neighborhood versus being the nicest house in the block. Um, Trying to think, we want to be in MSAs that are at least 200,000 people. So I don't want to be in smaller markets just because they tend to have less employment drivers, more reliant on one or two major employers, and there's a risk there that can change and change demand.
Mm.
Um, Beyond that, we don't want to. We're now not buying anything built before early '80s.
Mm.
So we've actually had a great deal in Colombia a couple of years ago that was built in the mid '70s. But just with you know the older properties tend to have more plumbing issues, more electrical issues. It's harder to get them, even with a lot of renovations. They just
Mm.
sometimes don't show as well as new properties. Like for example, if there's a significant amount, actually hard if there's even any 2 bedroom, 1 baths, I'm typically not interested. Like I
Really?
want minimum
Mm.
two twos.
Mm.
Because you can always renovate a 2-2 and make it look nice, but you're not going to add another bathroom
That's right.
to a 2-1. So it's sort of capped at a certain price point and um, kind of quality level, I guess.
That makes sense.
So,
That
so,
makes a
so
lot.
some of those are the things.
Yeah. Um, you I think having that type of insight in regards to the area as far as uh population growth, like potential um, you know, growth in the market. I guess having that team when they're doing the underwriting, when they're doing the acquisitions and everything, is important. You don't want to, like you said, you see red flags in regards to flood zones, in regards to um, the population being under a certain amount. You want to make sure, and also the jobs that's in the area too, that will tell you um, typically if they're high end type jobs or either in the middle, um, not low end type jobs. You want to have a good same thing with the job areas. You want to have a good, diverse type of environment when it comes to jobs. Because if one major company goes down, you don't want, you know, that to, trigger the downgrowth in population.
Right.
So
Right.
it's important. That's very important to have a good, uh, diverse amount of jobs local to the area. As you
Right.
stated earlier, you was in Boston, you found other tertiary markets that were within the vicinity of what you wanted to invest in, and I'm pretty sure most of those jobs were centered around Boston or
Yeah.
around those areas. So
Right.
that's why not only just to look in your own backyard, but look around, go outside, go and ensure that if it's too expensive in your market, you can look around the other areas and see that there could be potential there. There are opportunities there that you didn't see. So um, that was a great point. Absolutely great point.
One thing I'm actually not a huge fan of is military markets. I enter the military, and
I
some
am
people, do really well
right.
on that. But what I found is they tend to be in more remote areas, and they tend
Mm,
to be big job drivers.
right.
So, there is risk there. If we go to a major war, depending on what the base supports, you could just see your population drop significantly. But like I said, some people who know those markets do really well in them, but
Right.
I don't, and it's not. I just leave that to those who do.
It's a risk. It can be a risk because they can move, that can shut down that unit, and then everyone moves like quickly. Like
Right.
it's you gotta really know the market and know the area and know the unit if you're going to invest with where the military is at. Now it can bring some great returns in that, but you just got to be very careful. So I know we've been talking about a lot about investors, about trust, about red flags, and here and there. I just want to shift focus a little bit here. When it comes to 1031 exchanges, have you dealt with 1031 exchanges in the multifamily sector, and when it comes to investors and everything?
Yeah, no, I've done a number of 1031
Can you
exchanges. I've
share
done
some
them.
experiences? Yeah, yeah, yeah.
Sure, yeah. I've done it for myself, as far as just selling one property and taking all the proceeds and putting it into another property. And then I've done a 1031 exchange of a syndication into another syndication
Mm.
and brought in two other sales as well. So yeah, that was probably the most complicated deal I've ever done.
Yeah,
It was
yeah. If you could share, share some challenges, share the
Yeah,
solutions that you
sure.
came to.
So I think the most difficult part is that there's no one person or no one vendor that knows everything that's going on. So
Mhm.
you are the person that is the cog of this of what's happening with a 1031 exchange of a syndication because your CPA is going to tell you the tax implications and like the rules on the
Mhm.
taxes, and your syndication attorney is going to give you like, oh, here's legally how you need to set it up, but there's no one that is telling you how those things are coming together,
Mhm.
and you really just have to figure it out. You have to be like, okay, here's our goals, and here's what we're trying to do, and here's all the moving pieces, and then take what I get from the attorney and what I get from the CPA, and make it work.
Mhm.
And standard real estate transaction, you're pulling a lot of the pieces together, but none of them are that complicated.
Mhm.
Like once you do it a couple of times, you're like, okay, like it's work,
Right.
but it's not that complicated. And doing a 1031 from one syndication to another and bringing in other 1031s at the same time is a lot of complicated work that no one else can check. I mean, I had partners that were like checking the work, but it wasn't like I could send it to my lawyer, like make sure this all looks right, because he's like, I don't know any of that, and the CPA is like, I don't know any of that. Like this is just my piece. So, yeah, what we did was we sold a 136 unit multifamily in Columbia, South Carolina, and we rolled about 60% of those investors into a 140 unit property in Baltimore. And it was a $12 million raise. We rolled about $6 million. And then we took in two other small apartment building sales that were investors basically. And they rolled in another million each.
Mm.
So we had, at the end of the day, we had four entities. We had the roll entity, which are all those syndicated, all those investors that rolled into the new property.
Mm-hmm.
We had the two other tenants in common, which are the two other properties that came in. And then we had the new investors, the new syndication that we ran to raise the other 5 million or so. So the way that is structured is that you actually buy the building in four pieces. And those pieces are different companies and they're tenants in common. And it makes the taxes a lot more complicated because they technically own like a piece of the building. So it's not like one company owns the building and these four groups are investors in that company. It's
right.
that these four companies each own a percentage of the building, which makes bank accounts complicated. It makes, it's four tax filings, four sets of K1s. It makes the fee structure for how to get compensated a little bit complicated from a syndication perspective. So I would say it was great because we were able to roll our investors and we're really happy about that. It was very complicated and it was probably double the legal and CPA costs, maybe even more than double of like a typical transaction. But it did make, a big portion of the raise very easy because so many people were like, oh, that's easy. I was wondering what I was going to do with this money. Now you just have an option. Like just do that.
Yeah.
So I'm glad we did it. I'm glad we have, I had to know how to do it again. It's working out well. But there's a lot of moving parts and a lot of like kind of last minute calculations that you have to like update like real time that it was stressful.
That sounds like a challenge and lesson learned.
It was a challenge. It was a challenge. But I would say a regular 1031 exchange, pretty easy. People think it's a big deal, but there's a couple timelines you have to hit. If you hit them, works out. If you don't, the money just gets locked up for like 180 days and then you get it and you pay taxes on it. It's not that bad.
Would you do it again?
I would certainly do a regular 1031 all day. Yeah. Syndication, yeah. I'd put minimums on them, so if someone wants to roll a property into one of our investments, they would need to pay the legal fees associated with it. And then, because we absorbed those into our costs last time. And then I wouldn't do it for less than $1 million investment.
That makes sense. It got to be worth it, Yeah,
it's got to be worth it. Right?
Especially with it seemed like a lot of intricacies into it and unique situations that I think you're one of the few that I've heard that did 1031 exchange with syndication. So that process had definitely, I'm sure you learned a lot of challenges, and you can do it again, maybe a piece of cake next time. So
yeah, right. Who knows? Yeah, we'll see. We talked about doing it on this deal that we're closing now, but there was no one big that had like a sale that they wanted to bring in. So we were open to it. If someone had like a significant amount of equity they wanted to roll into it. But it just we didn't have anybody come to us with that. So I was a little relieved, to be honest.
Well, Chris, I know we're getting short on time and I've been enjoying the conversation that we've had. Let's go ahead and just go into, if you any final thoughts that you have, and then can you also share how people can connect with you and any other things that you want to share with the audience before we close it out?
Yeah, sure. So I would say, anybody who's interested in getting involved more in real estate, it's great to listen to podcasts and read books, but you're not going to really start learning until you do something, whether it's invest in a syndication, whether it's, buying a single family rental or a duplex, or because you're just going to go through all these steps and, not know what to do and then figure out what to do and then get to the next thing and learn all these lessons. So I would just say, if this is something you're interested in, just take a definitive step to do something, in the next 12 months. And one thing I found really helpful when I was getting started was was telling people what I was going to do, like telling my parents, telling my friends, like, hey, in the next year, I'm buying an investment property. Because what that does is the next time they see you, they're like, oh, how's that going? Like, how's that, you buy an investment property, you buy one yet? And you know that that's going to happen. So you're like, you kind of make other people hold you accountable to your goals. Where if it's some sort of internal goal, then you miss it. Like no one knows. You can just keep moving the goalpost. But if you know, like the next time you see a grandmother, she's going to say, hey, you mentioned last time that you were going to invest in real estate. Have you done that? Like you want to have some progress. So I found that valuable. And then if you want to reach me, you can reach me at emcapitalgroup.com. And I'm on LinkedIn as well, Christopher Lento, emcapitalgroup.com. Other than that, I'm not a big social media guy, just LinkedIn and email and websites. And yeah, my calendar link's on there. I'm happy to get on a phone call and talk about our investment strategy, how we can possibly work together.
Awesome, Chris. I really enjoyed this conversation. I really enjoyed everything that you brought to the table. And again, like he said at the end, like you got to be a doer. Go out there and do something if you want to get into this real estate game. Share with everybody that you can. Mom, dad, pop, your dog. Maybe not your dog, but can't speak back to you. But share with everyone. To hold yourself accountable, and then they'll hold you accountable too. But yeah. Chris, it's been awesome. We'll include everything that you share with us in the show notes in regards to reaching out to you, your LinkedIn, and we'll wrap it up here, and we'll see you next time. Thanks again, Chris, for today.
Yeah, thank you. I appreciate it.